Hello students, this is Sonette Smith and this is the last lecture on companies. I'm going to make this lecture into 3 parts. So this first part will be more theory, and then I will have 2 separate parts where I'm going to be doing question 8.8d and question 8.13. They will be on separate video clips. But this presentation will give you an overview of what we've done so far in companies, and we'll finish off the things that we still needed to do with regard to redemption of preference shares. So these are the learning outcomes of the 4 lectures on companies that we've had so far. We've looked at an overview of the different types of business entities. Then we did an introduction to companies. The important thing to remember about companies is that the business is now separate from the owners. It's a separate legal entity, which means that the owners now cannot be held legally responsible except in certain instances, which you don't need to worry about for this course. It means that the owners can't be held responsible for the debts of the business, and it means the company is a legal entity in its own right. We looked at accounting entries for the issue of shares. We looked at accounting for conversion of par value shares into no par value shares. So there are journal entries there that you need to do. Then we looked at disclosure, the note for share capital, how you disclose equity in the statement of financial position, how we disclose share capital in the statement of changes in equity, how we account for tax on companies, how we talked about transfers to and from other components of equity, and we also calculated an account for dividends on different classes of shares, and I'll talk a little bit more about that today. And then we accounted for revaluation reserves, and preparing the statement of changes in equity is something that I'll be doing in today's lecture and question 8.8d and 8.13 as well, because with a company there are quite a few things that we need to take note of in the statement of changes in equity. So what we've already covered in chapter 8 are pages 213 to 236. And these are the questions you should already have been able to do. Basically, by the end of today's lecture, you should be able to do all of the questions, and I encourage you to do as many as possible. The solutions that you need are also loaded onto ClickUp under the subject content folder. So in this lecture, we're going to look at the redemption of preference shares, and finally, we're going to look at the statement of changes in equity, showing the effect of the appropriations. That means the different ways that we've used the equity of the business, and we're going to show how you reflect those in the statement of changes in equity. So we're completing chapter 8. I'm going to be doing question 8.7 in this part. Then, as I said, we'll have a separate video for 8.8d and a separate video for 8.13. So let's quickly talk about cumulative and non-cumulative preference shares, and talk about dividends on preference shares. So the general rule for dividends is that a shareholder has a right to a dividend only if the directors decide to declare a dividend. So you can't get a dividend if the directors haven't decided to declare a dividend. However, preference shareholders always get paid dividends before ordinary shareholders do. So the reason we call them preference shares is because they have preference over ordinary shareholders. But one of the big differences is that preference shareholders don't normally have voting rights, whereas ordinary shareholders do have voting rights in the general meetings and annual general meetings of companies. Most preference shares are cumulative. That means if a dividend doesn't get paid in 1 year, then it has to be paid the next time dividends are declared. Cumulative dividends are paid before non-cumulative preference and ordinary dividends. In FRK 121, you will assume that most dividends on preference shares are cumulative, unless we tell you otherwise, and most of the time we will have dividends that are paid up to date. We won't make it too complicated. So what you need to remember is that dividends only get paid out when dividends declare it. But in FRK 121, when you see preference shares, The dividends are usually cumulative unless you're told they're non-cumulative, and we will then normally not make it that cumulative dividends have not been paid. We will normally always, in the questions we give you, make sure the dividends are paid on time. So now let's talk a bit more about redeemable preference shares. So in terms of the Companies Act, redeemable preference shares can be redeemed or bought back. Remember what happens with the redeemable preference share. It's a way for the company to raise money. They issue shares and investors then buy shares in the business, in the company. And if they buy redeemable preference shares, it's as if they're lending money to the company, because redeemable means that the company has to redeem the amount. In other words, they're going to buy back the shares and give the money back to the preference shareholders. If that redemption, first of all, let me say, not all shares are redeemable. If redemption is at the option of the company, then preference shares are part of equity. So if it's up to the company to decide whether or not they're going to redeem preference shares, then that is not like a liability. It means the company may never decide to pay it back, and that means that type of preference share is equity, and we treat the dividend as normal dividends, and it goes on the statement of changes in equity. But if there is a fixed date for redemption, or redemption is at the option of the shareholder, remember the shareholder is the one who's paid money for the shares, they've given the company money. In this case, the preference shares are considered to be a liability, and you will show it as a long-term liability, and any amounts that are due within the next 12 months will be current liabilities. And in this scenario, your dividends are treated as part of finance costs. They are treated as an interest expense. And usually with these types of preference dividends, there will be preference shares, there will be a fixed dividend that's cumulative, that gets paid every year, might even be more than once a year, which really makes the arrangement with the preference shareholders like a loan arrangement, which is the reason why we show the amount that has been paid for the preference shares as a liability and not equity. So when we redeem preference shares, we are going to be buying them back. We are going to credit bank because we're now giving money back to the people who lent us. So when we credit bank, we're reducing the money in our bank account, and we're now reducing redeemable preference share capital, which would have been part of liabilities. Remember, when we originally created the share capital, we would have received money and credited redeemable preference share capital. Now we're paying back the redeemable preference share capital, so we debit redeemable preference share capital. In question 8.7, we have an example that I'm going to do with you to record the redemption of preference shares on the 31st of July in the General Journal of Jupiter. So on the 30th of June, that's 1 month previous, Jupiter had the following balances. They had ordinary share capital, 200,000 shares at 270,000 Rand. Redeemable preference shares, 40,000. The total value is 80,000 Rand. They had retained earnings of 125,000 and money in the bank of 70,000. All the preference shares, that means all 40,000 shares, have to be redeemed in cash. In other words, we're going to make a payment out of our bank account at 2 Rand per share on the 31st of July. Therefore, the preference share capital is a liability. There's a fixed annual dividend of 15 cents per preference share that has to be paid annually. In this question, a lot of the information is actually not relevant because all we have to do is record the redemption. So we can actually ignore the information they give us about ordinary share capital. We ignore the information they give us about the retained earnings in the bank account. We ignore the information that they give us about the fixed annual dividend. The only information we need is that there were 40,000 shares and we're redeeming them at 2 Rand per share, and you will see 40,000 times 2 Rand means we're going to be paying back the total 80,000 to the preference shareholders. So our journal entry is going to be credit bank, that's with 40,000 times 2 Rand, 80,000, and debit, the 12% redeemable preference share capital, which we would have disclosed as a liability in our statement of financial position. And that means there will therefore be no redeemable preference share capital remaining in this company. So we'd been lent money by the preference shareholders, but now we've repaid the money and there's no liability remaining. I'm going to do a separate presentation for you where we're going to look at question 8.8, and we're going to look at part D of question 8.8 because that's the only part we haven't done. I did the previous parts of question 8.8 in lecture 4, so you can go back and look at lecture 4 to see my presentation on the previous parts of question 8.8. I'm also going to do a separate presentation on question 8.13. So I'll go into that in a separate video. And then finally, your homework after this is that you should try and do question 8.14. But basically, after you've finished this lecture and have looked at my presentation on question 8.8D and question 8.13, we've now completed companies, and you should try all of the questions. And if you have queries, please email me and I'll try and get back to you as soon as possible.